Hi everyone, and welcome to episode 4 of the Introduction to Forex Trading series. In this episode, we're going to be discussing all things related to brokers. I'll explain what they are, how they operate, and then I'm going to shed some light on some of the unethical techniques used in the broker industry. Additionally, at the end of this episode, I'm also going to be completing a full explanation on trading leverage. This is going to be a very important lesson if you want to get started on the right path in your Forex trading journey. So tune in, take notes, and pay attention. Okay, so let's start at the beginning. What actually is a broker? The role of a broker is to act as an intermediary between you and the market. Without a broker, we couldn't actually enter into the markets, so it's a very important part of our trading infrastructure. Choosing a high-quality broker is very important, because they are the actual entity which holds your trading capital and is responsible for correctly executing your trades. Unfortunately, there are a lot of low-quality brokers around in the trading space who don't do right by their clients and actually use them to make money on the side. This is a major problem in the trading industry, which our team is actually happy to expose. To be aware of the full extent of this issue, you first need to understand what the broker business model is. When you place a trade with a broker, they make money in two ways: spreads and commissions. A spread is a very small markup on the price that a broker can offer you on a trade. Then you have commissions. A commission is a separate small fee which is charged based on the amount of volume which you trade. Essentially, what you're paying for with spreads and commissions is the cost that the broker has to pay to actually acquire the liquidity from a liquidity provider. So it is an essential expense, but what brokers do is they then apply a markup, which is basically how they make their money. There's nothing unusual about paying spreads or commissions to enter a trade. All brokers do this, and as I said, it's the standard business model within this industry. However, there is another trick that many brokers use which makes them even more money than spreads and commissions combined. And this is what's important to understand. So let's take a deep dive into it. Brokers are split into two categories: A-book brokers and B-book brokers. When you place a trade using an A-book broker, the trade is placed directly into the market, which is what we want. However, when you trade on a B-book broker, the trade can be placed into a false internal market which is run by the broker. So what this basically means is that instead of placing the trade into the real market, the broker fills your trade internally with their own capital. What this means is that if the trade is a win, the broker pays you directly out of their own funds. And if the trade is a loss, the broker then keeps your money. So the key point to understand is that instead of actually placing your trade, the broker pretends to place the trade and simply agrees to pay if it's a winning trade. I know that this sounds pretty wild, but this happens all the time in the Forex space. This won't make sense until you understand why they actually do it. The reason why B-book brokers do this is because they know that most traders coming into the markets are not going to trade properly and thus are more likely to lose money than make it. So by setting up this artificially designed market, they can make a lot of money from your trades. This situation creates an obvious conflict of interest, because the broker has a business interest in you losing trades. Because of this fact, you really can never trust a B-book broker to properly handle your positions. They may do things like increase the trade fees at the right moment to make your trade a loser. The point is, you can't trust them to do right by you because as a business, their primary obligation is to make money. Now, obviously the model works very well if people don't make money, but what happens if you're on a B-book broker and you do make money? If you're in that group of traders who do make money by consistently winning trades, the brokers will probably just switch you to an A-book feed, which means that they'll actually place your trades into the market, because they certainly do have the ability to do that. They simply choose not to for people who aren't profitable. However, in some cases, they might even take their shady activity a step further and try to push you off the platform, because they simply want exclusively B-book clients. So that's what B-book brokers do, and the process that we just discussed is called B-booking. Now here's something which is really going to blow your mind. If you've ever seen a Forex affiliate broker deal, you'll probably notice that they're offering up to $800 for one client referral. That is a lot of money. And you've got to ask yourself the question, why is a broker offering so much money to get a new trader? Well, it's because they know that they can book them. The way that you can confirm this is that you can go and look at affiliate deals from an A-book broker and you'll see that they're offering much less per client. When you break it down like that, it all makes sense. Fortunately for us, when you're trading with an A-book broker, you don't encounter any of these problems. A-book brokers only make money on spreads and commissions, which occurs when you enter your trades. So in this case, their business interest aligns with you making money and staying with them as a broker. So they have no reason to manipulate your trades. When you place a position, it simply gets put into the market and that's the end of story. So if you're serious about trading, you should be using an A-book broker. They are much more ethical as a business and you will have a higher probability of achieving success in Forex simply by knowing that your positions are being correctly handled. When it comes to choosing a broker, the status of their booking system isn't the only thing to look for. You're also going to want to consider the following points. Who does the broker use as their liquidity provider? A liquidity provider is generally a bank which the brokerage uses to source the funds required to offer leveraged trades. For account security, it's very important that your broker has a good liquidity provider. What platforms does the broker offer? Are they compatible with MetaTrader 4? Most brokers will be, but it's important to check. How good is their customer service? If something goes wrong in your account, you're going to want a high quality broker who has a good interactive support team. We would suggest reaching out to their support team simply to test for quality and response time. Does the broker have a good reputation for payouts? And how much flexibility do they provide in their payment systems? And finally, how good are their actual trading systems? Do they have good execution speeds? Are the commissions calculated correctly? To test this out, what we would recommend doing is simply signing up for a demo account with the broker. This is a simulated trading account, but what it will do is show you what you can expect in terms of spreads, commissions, and execution systems when you're actually trading live with the broker. These are all important factors which you should take into consideration when selecting a Forex broker. Okay, so that's some great information about brokers. But while we're on the topic of brokers, I'm going to add a bonus section into this episode covering leverage. Leverage is a very important part of Forex trading. Leverage allows Forex traders to open up positions which are much larger than their base account size. To explain this point, I'm going to step you through a practical example. For this example, we'll assume that our trader has a $10,000 trading account. Following a standard risk profile, let's also just say that our trader risks 1% of their account per trade. First of all, we're going to take a look at a theoretical trade example which is not using leverage. On a $10,000 account, risking 1% per trade, the total size of that trade would be $100. Now, for our trade, let's say that we're buying a currency which is worth 1.35 per unit. We can find our trade size by dividing our trade size, which is $100, by the price per unit of currency, which is 1.35, we can determine that in this trade, we will be buying 74 units of currency. For this example trade, we'll say that we have taken a long position and have a take profit set at the 1.36 level. The trade hits our take profit order and we automatically collect our profit. In this case, our profit can be determined by multiplying the number of units we purchased in the trade by the value increase per unit. With an increase of 0.01 over 74 units, the trade profit is 0.74. Okay, so good stuff. The trade was a winner and that's good. But the result isn't very impressive and it's certainly not going to allow you to retire early. This is why brokers offer leverage in Forex trading. The currency movements are so small that we do need to leverage up our accounts if it's going to make a difference. So now let's take a look at the same example again with the use of leverage. Once again, we have a $10,000 account and we will be risking 1% per trade. Our broker is offering us leverage at a rate of 1:500. Which is pretty widely available within the Forex space. At 1% risk, once again, our trade size would equal $100. However, as we enter the market using a CFD, the leverage is applied and our $100 trade gets multiplied by 500, making it now a $50,000 trade. Once again, the initial purchase price of the currency is 1.35 And with this, we determined that we can now purchase 37,000 units of currency. We take a long position and have a take profit set at the 1.36 level. The trade hits our take profit order and we automatically collect our profit. Once again, our profit can be determined by multiplying the number of units we purchased in the trade by the value increase per unit. With an increase of 0.01 over 37,000 units, the trade profit is now $370. For a $10,000 account, that's quite an impressive amount of profit, and that example demonstrates why Forex is a very popular trading style. Leverage allows us to scale up our trades with the same amount of base capital. This is only a theoretical example, and in practice it can work a bit differently because there are additional factors to consider, such as your stop loss size and broker margin requirements, but this is a good general explanation for you to understand the principles of leveraged trading. So with that said, that brings us to the end of this episode covering brokers and trading leverage. So thanks for tuning into this episode, and I'll see you in the next one where we're going to be discussing the life-changing topic of investor funding. Thank you.